Happy New Year. Welcome to the first quarter market update from John Giordani, the Chief Investment Officer at Planning Solutions Group. So far, investors have not greeted this new year warmly as they've been in a selling mode, so let's jump right in. Last year was pretty frustrating for investors. Our key theme was expect volatility to pick up as investors had become pretty complacent after years of up markets. Most asset classes finished the year with losses. We saw oil prices plummet while the dollar soared, and for the first time in 9 years, the Fed hiked short-term interest rates. This year, many of the same issues remain front and center. Emerging market economies like China are experiencing a slowdown, while developed economies exhibit below-average growth. Commodity prices remain weak, and central banks are pursuing divergent monetary policy. In addition, this is an election year, which should add more uncertainty to the markets. Geopolitical risks remain high. The newly elected president is going to have to contend with many international issues. Besides Russia, Middle East tensions are rising, and it now appears that North Korea is more of a nuclear risk as they claim to have tested a hydrogen bomb. The good news is that most asset classes bounced back in the fourth quarter from the terrible summer which featured a stock market crash. However, most asset classes were down for the year. There are a lot of red numbers in the chart to the right under the 2015 column. Global stocks, which include both U.S. and international stocks, were down nearly 2.5%, while global bonds were down slightly more. Commodities remain in an over 4-year bear market and were down over 26%. With many stocks down over 20% last year, it is surprising that the overall market indices weren't down more. The investor darling, the maker of the iPhone, Apple, has even had a significant correction as it's down nearly 25% from its 52-week high. And when the most infamous investor, Warren Buffett's Berkshire Hathaway stock, was down 12%, you know it is a challenging environment. One asset we left off the chart were home prices. There is some other good news, as that based on the Case-Shiller numbers, home prices were up 5.2% last year. Let's also not forget that most asset classes have generated positive returns over the past 7 years. Stocks have more than doubled over this time period. As we head into the new year, there is no shortage of material for the annual Right of Investment predictions. The experts were wrong once again last year. The average Wall Street strategist was looking for an 8% gain in stocks, which obviously missed the mark. In fact, this is nothing new. Morgan Housel, a columnist for Motley Fool website, looked at the average Standard & Poor's 500 index forecast made by 22 chief market strategists of the biggest banks and brokerage firms from 2000 to 2014. On average, these annual forecasts missed the actual performance by an incredible 14.6 percentage points. Looking at other asset classes, the same is true. Most stated oil prices would recover, which didn't happen. In addition, the consensus forecast for the 10-year Treasury yields was for them to rise significantly. Most predicted a rate near 3%. Yields remain pretty much near the same level as they were at the end of 2014. My advice is to read the predictions for entertainment while sticking to your investment plan. The difficult period for asset prices is not unexpected. At the beginning of last year, our main theme was to expect volatility to increase as we were seeing too many investors becoming complacent. Many wanted to increase risk as they were becoming more confident because prices continued to rise. This is usually an indication of late-stage behavior when investors forget that asset prices may also go down. As shown to the right, last year's stock market action was really a continuance of a frustrating 18-month period where prices have been volatile but pretty much wound up flat over the period. Looking at data since 1929, stocks have been down on a calendar year basis 24 times, which is around 28% of the time. One caveat, looking at performance or data over short periods of time like a year and using this to make significant decisions or changes is a pitfall that many investors fall into. No strategy, asset class, or manager works well in every year. Abandoning your investment plan to try something else will likely leave you disappointed with your results time and time again. I recently spoke to an investor who stated that he has never had any success in the markets. After his answers to several of my questions, it was easy to see that it was a classic case of letting behavior dictate decisions, jumping from ship to ship to chase the hot asset class or manager, getting out of investments as it felt bad due to the news or that the investment hadn't done well were just a few of the examples. I never heard him mention any of the fundamentals that we preach, including having a plan, being aware of how much risk is in the portfolio, diversifying, not market timing, rebalancing, and limiting fear ingredient investment decision-making process. Displayed in this chart are the quarterly earnings for companies in the S&P 500 stock index since mid-2010. After several years of earnings growth, last year we entered into a period of declining earnings. Stock prices generally follow earnings, so it's not much of a surprise that many companies struggled last year as their earnings came under pressure. The collapse in commodity prices hammered the earnings of energy companies, while a very strong dollar hurt exporters. Since both of these factors are cyclical, the headwinds should begin to moderate. However, for stocks to continue to regain their upward path, we will need to see earnings growth return. Perhaps the most overdue announcement came at the end of the year as the Fed finally increased the Fed funds rate from 0% to 0.25%. Should the U.S. economy continue to exhibit growth with gains in both wages and employment, and we see the volatile last couple of weeks settle down, we would expect to see a couple more hikes this year. There have been 5 interest rate hiking cycles over the past 35 years. On average, there are 9 hikes over a 14-month period that raise the Fed funds rate by an average of a little over 3%. Historically, the impact on intermediate-term bonds has not been as significant. Shown here are the changes in 10-year Treasury bonds over the past 5 increasing rate cycles. On average, 10-year Treasury bond yields have only risen by 1.3%, with the range of a 0.49% increase in 1999 and as high as 2.7% in the early 80s. As investors, we would welcome higher interest rates as we would be able to generate more income from our bond and fixed income investments. We have been faced with ultra-low rates which have penalized savers. Unfortunately, we do believe rates will remain lower than historical averages for much longer than people expect. For 7 years, this has been a core theme of ours. Also, let me remind you of our discussions from previous presentations about rising interest rates, concerns, and the impact on the portfolio. Not all bonds or fixed income strategies are created equally. There are many different types of bonds and strategies, some of which benefit from rising rates. There are moves that the portfolio managers may take in the portfolio to protect against rising rates. In addition, looking at historical data, bond bear markets are short-lived and losses minimal. Over the full cycle, returns have been positive. Do not buy into the media hype, as their job is to sell ads. The data just does not support their dire predictions. While the U.S. pursues a tightening monetary policy, other major central banks are continuing to press the accelerator to the floor. The U.S. Fed abandoned asset purchases or quantitative easing over a year ago, while European central banks and Japan continue with aggressive asset purchases to the tune of around $175 billion per month. This may help support asset prices. The divergent monetary policies may make selective non-U.S. assets more attractive. Because central bankers are such large players in the markets, their announcements may continue to move prices. In the last slide, we mentioned that accommodative policies by non-U.S. central banks may help support their asset markets. Looking at international stocks, they have underperformed U.S. stocks for several years. Over a full cycle, the performance generally evens out. And let's look at valuations. The top chart looks at the forward price-to-earnings ratio. Overall, the PE ratio shows that companies are fairly valued based on history. However, they are cheaper than U.S. stocks, so there is relative value there. Now look at the bottom chart. While U.S. stock prices are well above prior peaks, as seen in 2007 and 2000, notice international stock prices as indicated by the purple line. This highlights that they are still well below prior peak prices. In addition, the gray bars are historical earnings for international companies. Notice these are well below peak levels as well. What could drive earnings higher? Economic growth could, and we are seeing Europe and Japan's economy slowly turn the corner. In addition, both of these countries have currencies that have been declining in value. This should help their local companies that rely on exports as their goods become cheaper to other countries. Barring any setbacks, the environment does look favorable for international equities. If earnings growth reaccelerates, prices may follow. While we are talking about foreign markets, let's spend some time discussing China, which is facing a slowing economy. This continues to be the biggest risk to the global markets. Outside of the US, China's economy has been the major engine for growth around the world. This is shown in the chart in blue. The IMF estimates that China has accounted for 56% of global GDP growth since 2010. So it's pretty apparent why China catching a cold has such a significant impact around the world. We need the rest of the world economies to start improving to help pick up the slack. Shown in green are the estimates by the IMF for the next several years. The IMF believes it will happen, but their crystal ball is no better than anybody else's. China is in the process of transitioning from an export-driven economy to one that becomes more consumption-driven. However, they face several structural issues that need to be addressed. They are another country with too much debt. In this chart, you can see the exponential growth over the last 20 years in debt as a percentage of GDP at right. Managing this, as well as an overbuilt and speculative real estate market, poses many challenges. Last summer, China chose to devalue its currency to help keep its exporters competitive. This set off global fireworks. Their currency likely needs to continue to fall on a relative basis for them to effectively compete globally. They also experienced a stock market bubble that burst last summer, which hasn't helped matters. There are lots of challenges for the government to deal with. The trillion-dollar question is, can a centrally planned government successfully pull this off? Consensus opinion seems to be yes, but if they are wrong and we have a hard landing, this would pressure markets globally. Moving over to an update on energy markets. Here is a chart from Jeff Gundlach at Double Line Funds. The white line and blue area is the supply of oil. The yellow line is the price of oil. Notice the yellow line. The collapse in the price of oil has been spectacular as prices are down over 65% in about 2 years' time. It's not so much a demand issue as demand has been steady. It is a supply issue. U.S. companies driven by new technology have become the swing producer, the fracking revolution. This has caused the imbalance in supply. Again, look at the white line. I don't think anyone anticipated that suppliers would keep pumping oil in such magnitude with prices this low. Now, countries and companies have been continuing to produce oil at any price just to try and generate some cash flow to make ends meet. U.S. rig counts are way down, and JP Morgan Asset Management estimates U.S. investment spending on oil is down about 50% from peak. Many companies will go bust. Supply should come back more in line with demand as we move more towards the end of the year. This environment continues to favor commodity buyers, not suppliers. Consumers benefit with lower prices at the pump. Companies like airlines benefit as their largest input cost is now much lower. However, countries like Russia or Venezuela that rely on selling oil as a major source of revenue will continue to have issues. We've covered a lot this quarter, but let's summarize some key points. One of our core themes has been expect volatility to jump. As uncertainty remains high and we are ramping up into an election season, expect prices to continue to remain volatile. As an investor, stick to your plan. It's been developed and put in place ahead of time so that your behavior doesn't take over and negatively impact your portfolio. We continue to favor high-quality stocks that pay income over speculative stocks. We believe that income continues to be an important source of return for investors. Established companies that pay dividends have weathered the storm before, and they will likely continue to do so going forward. The recent sell-off highlights the risks of owning more speculative stocks, as these companies' prices are down much more in many cases than the overall market. We also still believe in having defense. Markets are not as cheap as they were 5 years ago. Defense gives an investor an opportunity basket to sell and use these proceeds to take advantage of low prices when the time comes. As opportunities present themselves, be prepared to reposition the portfolio, but don't move all at once. There are still many risks, and the environment has changed from the one that existed earlier in the cycle. Prices could go lower, so patience and moving slowly may be a better approach. This wraps up our current market update. If you have any questions, contact us at 888-740-3501. You may also access more information, including timely articles and account information, by visiting our homepage. Please watch for another market update in April. Thank you so much.